apologize for a delay here. We had technical difficulties, but we'll go ahead and call the meeting to order at 2:02. And then, John, do you want to do roll call as the secretary to make sure we're all here?
Yep. Tony Badalamenti.
Here.
Sabrina Christian Bennett.
Here.
John Kennedy. Here.
All right. Has everyone had a chance to take a look at our meetings, meeting minutes from our meeting on March 28th, 2024?
I'll make a motion to accept the minutes.
Okay, do I have a second?
I'll second that.
All right, all in favor say aye.
Aye.
Okay, unanimous, the vote carries. All right, next in line we have Miss Eileen.
Good day, ma'am.
Good morning, or I should say good
Good
afternoon.
afternoon.
I'm always sitting here in the morning, so, okay. Good afternoon, Eileen. Do you got some good news for us?
Yeah, I do.
All right.
We're gonna take advantage of this good news for quite some time here. that's the plan, to say the least.
Very cool.
Yeah, no, absolutely. I mean, it certainly is again, hard to believe another quarter has gone by
Yes.
and more now, and it's the summer. The year is halfway over.
I know it's hard to believe July 4th is next week. That's like the
Right.
midpoint of summer. I'm
Yeah.
like, where did June go?
Yeah, back to school sales will be starting. My daughters will tell you. They've already purchased stuff online.
Bill's coming your way, Dad. That's nice of him.
Keep the spending going. We need the consumer to keep
Yeah.
spending.
Wait till the sales tax.
Uh-huh.
Yeah, right. But anyway, yeah, it is hard to believe that, right, we're halfway through, and as we know, when we look at those overnight rates, we're in the same spot that we were when we started out the year. But we broaden that out and look across the entire maturity spectrum, we've had a lot of ups and downs. And so one of the things that we have put together, if you want to look into the material on page 3, is just kind of this, trying to simplify, dial down really, what is it that's impacting interest rates? And we have a new chief investment strategist. He's creative, which is great because he's able to take complex ideas and make them to demonstrate really the pertinent points, so we don't get lost in some of the weeds all the time. But we have this Figge model of interest rates, which basically identifies, the components that do drive interest rates. As we know, Federal Reserve policy is first and foremost the driver for short-term interest rates, but they make those decisions based on the level of inflation, expectations for inflation, the economic growth in the U.S., as well as then the employment picture. And then, of course, all of this feeds into not only the Fed setting those short-term interest rates, but also what the market believes is the appropriate level for the longer-term interest rates. So when we look at then and dive into each of these components, we can see really how there's been some improvement in some, a little bit of starting to shift on others, and just some variation in the data as well. So currently, we know that the Fed is on hold. They've been on hold now almost a year.
Yeah.
It's a year, and that clearly wasn't how the story that it was in the second half of 2023, because in that second half of 23, the Fed was still talking about potentially one additional rate hike. And then we got into December, things pivoted, and the Fed pivoted the discussion to rate cuts.
Yep, and they had predicted 3 to 4 early on in the year.
Yeah, much more.
And
right. Now 1 to 2, 1 to 2
Yeah.
rate cuts expected. And so we can see really how the market has reacted really to the data. That's the bottom line on page 4. And this is the Fed funds future market, which is an indication of the market's expectations for that overnight rate. Actually, we're showing here at the end of December. And so, right, John, to your point, in January, when there was the expectations for more rate cuts, there was expectations for the economy slowing down much further. We had the market adjusting their expectations as well and pricing in, expecting the Fed to make pretty significant rate cuts. And then as the data came in, it was showing a little stronger. The consumer was more resilient than expected. Then we started to see those expectations start to decrease as far as the number of rate cuts, and that today we're at the point where the market's expecting 1 to 2 rate cuts yet in 2024. So we don't think that the economic conditions are such that the Fed will not cut rates. So we think that the conditions are such that the Fed will cut rates. It's just a matter of when is that first one going to happen. September, very high probability. November, a much
I
higher
was just gonna say,
probability.
Yeah,
November.
right, pre and post
First
election.
part of November, I bet.
Yeah.
2 days after the election is when the Fed meeting would be.
Uh-huh.
Yeah, so, and then we have another meeting also in December. So there's several opportunities really for the Fed to cut rates yet in 2024. We think anything in the summer, the late July meeting's off the table, but clearly September now is a possibility still, because we have started to see some pullback on some of the inflation numbers, but clearly November has a very high probability at this stage.
Very good.
Yeah. So,
Well, they can move anytime now.
I-
We've been waiting.
Where are consumers at, in terms of confidence?
consumer confidence, it's gotten low from the standpoint of particularly of the outlook for the impact on inflation. Because as we know, inflation, while it has come down, the level of prices have not come down, because inflation is a change in prices. So that means, no, prices haven't continued to go up at the rate of pace that they did
Right.
previously when we had this very high inflation of around 9%. So that impact of that cumulative inflation for the most part is still there. Now granted, we're seeing some return of prices kind of back to pre-inflation levels, but not widespread. I mean, things like, okay, the promotions that the fast food chains are doing, whereby, they're having the value meals where,
Yeah.
Yeah.
it's not gonna cost, $10 to $15 to just get a
Yes.
burger and fries and a drink. It will be only $5 again. But those are promotional items, and we'll see if
That will phase out probably.
probably.
Yeah.
We know that, just the cost of food, the cost of labor,
Energy, everything.
it's still elevated.
Yes.
Yeah, so it's having that impact on the consumer particularly, because, that's what we all feel, you have to spend money to maintain, that element of safety and feeding your family. But the consumer is not convinced that inflation is, going forward, not going to have a negative impact on them. Now, clearly, the consumer has shifted to rely more on credit cards to fund their standards of living, and that, of course, has the likelihood of being very problematic, because if you have a combination of your increasing your balances, and if part of that increase is because of the higher rates that are on that, that could be a very big hole for some folks to get themselves into. So when we look at that inflation number on the second page, it has had come down, and we look at that 5-year average, and over the past, going back into the mid-1990s, inflation on average, has been below 4%. It's only had just now, on average over a 5-year period, picked up to be over 4%, even though now the pace of inflation is going down. So this will be what we feel will be a short-lived, long trend, but clearly, as we can see, inflation, does have a tendency to move around. It's not always at that 2% target range that the Fed would like. But the question becomes, will the Fed at some point, say, oh, we don't have to get to 2% in order to lower rates? And we think they have said that, not necessarily direct, but indirectly, that they just need to see that continuation of progress with lower inflation. And the last inflation read we had did support that as well. So that will allow them to kind of shift their focus to their other side of the mandate, which of course will be the jobs picture. But of course, inflation has an impact on economic growth in the U.S. So when we look at what the forecasts are for economic growth in the U.S., we look at the Bloomberg survey and the blue highlighted area. Expectations for 2024 growth are much lower than what what the growth rate was in 2023, and much less than what really is considered trend growth. Trend growth is traditionally, for the US, recognized as 3% growth, but yet for 2024, expectations are that the overall growth will be below 2%. Yeah,
I have an unfair question.
go ahead.
So, we know wages have gone up, but what's the gap between where wages are currently and inflation? You know, that gap there.
Wage growth?
Yeah, wage growth, yeah.
Um,
Cause I know it's not there.
Right.
There's still a gap.
There is a gap, right, and that, I think, gets back to to just the way that, we look at inflation. You're right, when inflation was high, that even if companies were able to extend to their employees 4 or 5% wage hike, they still had a gap.
Right.
Wages were not growing at the same pace
Right.
as inflation. But now with inflation closer to 3%, if wage growth is
Increase.
4%,
Yeah.
then
Yeah.
You're a little ahead.
then you're a little ahead. You never make up what you didn't get previously, and that's,
Correct.
I think, the conundrum that
Correct.
we're in today.
Yeah.
So the wage increase, and that's
Mhm.
been pretty significant over the last couple of years.
Yes,
How does that ever right itself? Because a lot of businesses can't really keep up
right.
with that, what they
Yeah.
took it all the way up to,
Mhm.
and it's very difficult to take wages down.
Yes,
Oh, and that's the problem.
So then you
Right.
keep it going with
They're gonna be
inflation.
froze for years to sort of live it out, but
And the
you gotta
price
be
index
competitive.
goes up. So
Right.
how does that work itself out?
well, couple ways. Companies determine ways to run their businesses with less wage factor, so increased automation. So therefore, they don't need
Less
as many
people,
people.
Right?
Right, they don't need as
Layoffs.
many people.
Yep,
They lay off.
yep,
Which
Or-
means more problems.
Exactly.
Yep.
Exactly. Or they keep wages steady, and, in essence, have like deficit spending, maybe, that compresses their margins, particularly if they're a profit, making business. So now they can make a determination, well, instead of we'll just say a 25% profit margin, we are okay with that compressing to 20% or 15%, because we may view that as temporary.
yeah.
Or they increase the prices of the goods that they sell
That's normally
to
what you
maintain
see.
that
That's
profit
what you
margin.
see.
So, because I never watched this into the last 4 years, at a time in history, in like maybe the last 20 years, has the pay jumped as high as it has in the last, for employees? Has this cycle ever, when was the last time that this cycle hit us like this?
I don't have the data handy, but I do know that, in past periods, we have had periods
Mhm.
where, wage growth has been much higher. I can give you kind of just a personal example. When we look back at these inflation numbers back on, page 5.
Mhm, that's what I'm saying,
Yep.
yep.
Yeah, and we can see that in the early 80s, inflation rose, over 14%, 15%.
Mhm.
I can recall myself personally working and receiving a pay increase of 10%.
Wow.
I didn't,
Mm.
I had a gap. Inflation was higher than my
Right,
wage hike.
As in the Marine Corps, everything was frozen anyway.
Yeah.
yeah, right.
It didn't matter.
But, yeah, so in that period, right, we had significantly higher wage growth. Now, those are kind of the extremes, I guess we would say, because inflation was clearly very high. When we look at these periods in the 80s, and the 90s, yeah, wage growth was maybe in that 3 to 4% range.
Thank you.
Yeah, and as we talked about earlier, to build on his point, the Fed, as they see more unemployment,
Yes.
they will lower rates.
Yeah, exactly. And that's kind of what we're kind of
It's
starting
what
to,
worked,
starting to get at that tipping point. Because when we look at the employment picture, and I like the one graph we have here on page 7, which shows
Yep,
that
yep.
we've had 27 consecutive months of the unemployment rate below 4%. Well, you have to go back to the 1950s in order for the US economy to have been experienced that. I mean, clearly in the 1960s as well, very strong period of time, but this is an anomaly. This is not normal to have the unemployment rate be below 4% for such an extended period of time. Now, we've just now, with the last employment update, the unemployment rate is now at 4%. So we will get a new unemployment rate read, I believe, next Friday. And the expectations are that that unemployment rate will start to creep up.
Yeah.
Because we have seen the increase
Yep.
in the length of time of the people who are on unemployment benefits. That statistic just came out this morning, this update, and it's showing that those numbers have grown too. So what that means is when folks are unemployed, they're not finding another job
Mhm.
right away, like
It's taking
they
longer.
were
Yeah.
a year ago.
Right.
We're at, or pre-pandemic, where, if you wanted a job, you could get a job. It's not as easy as it has been.
Well, I think it goes back to the employers having to make that tough
Yes.
decision. Do we want to reduce our overall profits and maintain the workforce we have?
Yeah.
Or can we scale that back and
Mhm.
right size
Yep.
our employees, so,
Mhm.
and office.
Yeah, it's
So-
definitely an interesting environment we're in. But to John's point, right, as we will perhaps start to see that unemployment rate, creep up, month after month. I mean, we've seen a big drop in the number of jobs openings in the US. That will also allow the Fed to actually move forward faster on cutting rates. Because the last thing the Fed really wants on their legacy is, the Fed kept rates too high for too long and it pushed the US economy into recession.
Yeah.
It's bad enough they have on their legacy that they missed the boat on the inflation picture and said it was transitory when it ended up not being so, but.
Right.
But any event, that being said, yeah, we clearly think that as we start to see these numbers move up, that this will give the Fed kind of permission
Right.
to
Yeah.
start to
Yes.
implement those rate cuts that have been long awaited for.
Yeah.
But in the same token, I mean, you certainly have to commend the Fed for having the fortitude to be able to say the data isn't supporting cutting rates yet, and so they've remained on hold.
Mm-hmm.
And of course, remaining on hold as economic growth slows, as inflation comes down, as, the job market, softens, keeping rates at those current levels is additionally restrictive on the economy.
Yeah.
And it's killing the housing market, we know that, still.
I was just at a meeting for NEFCO, and Stark County actually had a study done on housing.
Okay.
Stark County has an average of 114,000 households, but they only but they only have housing for 88,000 households. There is a huge gap
Yeah,
in the housing market, and it's not gonna go away anytime soon.
right, yeah, exactly.
It's crazy.
That is crazy. I know I've seen like the housing starts numbers on new construction are down, and.
Yeah.
What's
That
because
just
the
is
interest rates and stuff,
yeah.
so people are choosing to stay where they're at and just fix or add to what they already have and know,
Yeah.
versus selling their house in
Yeah.
24 hours and then having no place to go.
Yeah,
Mhm.
Yeah.
Yeah.
People selling their houses at Aurora are still making money. As soon as they put it on, there's bidding more for the house.
Yeah.
But you better have a house to move into.
to.
You better have a
Yeah.
house to move into, that's the problem.
Yeah, they don't,
Mm-hmm.
unless they're
Or-
moving.
Affordable housing, and
Mhm.
Sabrina, you know this better
Yeah.
than anybody, what a major issue it is here in
Mhm.
Portage.
Mhm.
And then rents.
oh, yeah,
And rents have soared too.
Crazy.
If you're trying to find a decent rental unit
Mhm.
in Kent, good luck.
yeah,
And I have rental properties, and I'm telling you, I've had to increase all of my rents, not because I'm being greedy, but my insurances
Oh.
have gone up on rentals because of all these hurricanes and
Oh,
every
yeah.
tornadoes.
Mhm.
It's all gone up, and now next year we're looking at our taxes. I mean, I'm not just raising them to gouge people. It's
Right.
because I have to.
yeah, you have to cover your costs.
Yeah. But I can honestly say I raised them $50 this year. I've not had one person question it or complain, cause they know they're still
Yeah.
under what I could get,
Mhm,
but
mhm.
it's bringing me closer to filling the gap.
Yeah, yeah. Yeah, I know some areas, right, the rental market is just like the housing market. Places come up for rent and people are lined up out the door
Yeah.
to try to get
It's sad.
in them, because, yeah, there's just not enough also rental units as well, and the prices have gone up.
I feel bad, I get calls all the time. It's sad. Fortunately, I don't have any openings.
Mhm.
I have one that I'm rehabbing, but that one may be gone already too, so,
Yeah, yeah.
yeah.
Yeah, so the level of interest rates clearly on page 8, we can see, you know, a big variation of when rates topped out back in October 23, versus then when, after the Fed had pivoted, and by January of 24, rates had dropped pretty significantly. Of course, that overnight rate, those short-term rates staying anchored to the Fed being on hold. And then, of course, as the economic data has varied, you know, we're kind of now in this midpoint here of where the market is again just pricing in 1 to 2 rate cuts, you know, but we're still able to get you know, dollars locked in for the county on a long-term basis, exceeding that 4% level, which from our perspective we believe still represents an opportunity. When we look back over 20 years or average rates, we're still at these high
Yep.
points overall.
Yep.
So any other comments, questions on the economic piece?
No, ma'am.
Great.
No.
So going into the county's portfolio, on page 10, ended May, this is as of the end of May, cash of 45 million, securities of 172 million. Gives us a total position for the county of 218 million. As John and I were talking prior to the meeting here, of course the cash is down pretty considerably from where it was when we last met, which was back in February, but we know that that's just a function of the cyclical nature of cash, and actually now that tax collections are coming in, Dennis just informed us that there was another 40 million
Yep,
that
yep.
was added.
That you could throw on there.
Yes, to throw on there.
Yeah.
But when we look at this position of where the county is at the end of May, we kind of view that as that's probably one of the low points of the county's cash position, because generally, right, it's before the point of collecting the next
Right,
real
right.
estate tax
Mhm.
collection cycle. Any debt payments that the county may have generally follow a May to November cycling,
Right.
so that cash has gone out the
Cyclical.
door. Yeah,
Yeah.
so it's very cyclical. So it kind of gives us a little, like I would call almost a pure look at the county's cash. And one of the things that we have found with most, you know, clients is that, you know, having that proper balance between cash on hand to meet operating expenses versus in the investment portfolio, what's that right mix? And it's generally around that 20% keeping cash and 80% in the investment portfolio. And it's ironic, we're like
Almost
spot on.
exactly right there.
We're right on the
Exactly.
2080, yeah.
Right.
That's, I was just calculating.
Right, yeah, exactly. You do some quick math and you go, we're right there.
Yeah.
So,
Yeah.
so this clearly, you know, right, does work for the county as well. So looking at the securities portion, as we have those funds invested, the weighted average yield has increased slightly. We're now at 3.19%, up from
Wow.
3.14%. Doing simple math, at 3.19% times the 172 million will generate on a go-forward basis about $5.5 million of interest income.
Wow.
Yeah,
That's good.
for the county, so that's a good
It's
number.
a good thing.
And so
Mhm.
far this year, actually, the investment securities, excluding the cash piece, has generated 1.86 million.
Yeah, it's
So,
not insignificant.
yeah, so that's a great number.
Yeah.
So the key, of course, to you know, investing the funds, one of the keys is, you know, having that maturity distribution such that are we you know, in an interest rate environment, are we taking advantage of the opportunities? And as we've talked, our strategy has been to try to maintain about 42% of the portfolio maturing beyond 3 years. And so when we look at what we have here today, if we add up those buckets of the 3 to 4, 4 to 5, and 5 to 10, we're at 38%. So we know that as we have maturities, we can continue to reinvest those funds longer term to lock in those higher,
High
longer
rates.
rates,
Yep.
yeah.
Yep.
And so over the next 3 months, we do have just under $12 billion maturing, that we would be looking to get extended out. When we look at what we currently have that's maturing in that 4 to 5 year bucket, I can tell you that those investments are yielding on average 4.42%. So, yeah, we've exceeding overall that kind of 4% baseline that we're trying to get locked in for the county.
That's great.
Yeah, so the last quarter's investment purchases on the next page, as we can see, average basis, we reinvested 13.465 million. Average yield on those investments was at 4.48%. And looking at the maturity dates, with the exception of the Portage Community Bank CD, which was rolled over, the maturity dates have been out in that 4 to 5 year bucket. So clearly, that's the strategy we discussed and that we have been executing. And all of this flows through to providing that interest income for the county. On page 12, we can now see our we're at the point today for 2024, if we add those two numbers together, the county can expect to receive 4.7 million just on the securities we have today in the investment portfolio. So that doesn't assume any reinvestment. And for 2025, just under 4.4 million. And that continuing 26, repeatable, 27 starts to drop down only by virtue of the fact that we're building up these longer maturities, and then same with 28 and 29 as we build up those maturities out there. Any questions there? Nope. So we have our historical view here, and so we can see going back to 2006, so this is 18 years. We're at a high point, not only on the amount invested, but of course also the interest income and the yield on the portfolio. We're back to levels that we had, just going into the financial crisis before we were in a very different interest rate environment than what we had been 20 years prior. So slowly building that back up to levels that will be very sustainable.
Good news.
Yeah.
As I said, yeah, that's good news. All right, any other questions, comments? John, did I miss anything?
I'm good.
I don't think you did. I think you touched on all the things that we kind of met about.
Okay.
So, thank you.
Thank you.
Thanks, Eileen. All right, next we have other business. John, you want to give us an update on GrowLink?
I would love to. So, you have in your packet, it's folded up. It's the longer sheet. It's there, Tony, yep. So, just to bring you back to how we left it after the last meeting, we we approved an additional 1 mil into the GrowLink fund, and we had a really good discussion at that time about the trucking businesses and how the money was being utilized, and we felt, I think we all agreed, that the economic impact that the money was having in the community was solid, was strong, and that money was being recirculated throughout the community based on some data that we had about the number of employees at these trucking companies and the different purchases they were making in terms of trucks and whatnot. I'm a bit disappointed that we only have one loan right now. It's for a homeowner.
Yeah, I see that.
Yep.
Over at Philpott.
Yep. And so we also talked quite a bit about doing a better job of promoting this program in the community. So I have been going out, and every time I talk to a city council, I've talked to Kent, I've talked to Ravenna, I've gone out to 4 townships over the last week and a half, and I really am promoting the loan program. I'm handing out the brochure, telling folks that we have this money available, but we need to do a better job of getting the word out about this money. Now, it is a below market interest rate, which is great, 1 to 3%, right? But that is ultimately determined based on the application and what the bank thinks the person who is applying for it deserves, right? So those are things left to the discretion of the banks that we're working with on this program. So, bottom line in my report to y'all today is I'm getting the word out, but I need to do a better job of promoting it and letting folks know that this money is available. But like Eileen and I chatted about prior to this meeting, it could be that people are just kind of sitting on their hands right now, waiting to see what happens with the economy, with the jobs report, with other indicators, with the election. Let's be honest about that.
Yeah.
A lot of people are waiting to see what happens and their level of confidence as a result of the election. So I'm predicting an uptick in loans in the fall, and I'm going to continue to double down in terms of promoting the heck out of this program, because I think it's a good program. Anytime you can get 1 to 3% below market on
Market
anything,
is good.
that's a good deal. You know,
Well, I have
the-
a question,
go ahead.
John.
Yep.
It looks like first of all, I don't know how much Robert Philpott needs, but because that part, but it doesn't look like we have a lot of money. Now, I thought we voted to inject more
Yeah.
into this.
Yeah, we
So
have
can you
we
tell
have
me-
900. If you look, it's not well marked here. I apologize for
Oh,
that, but there's a
okay.
gap in amount left. You have 988.
Left.
Yeah, 988,000 left.
Because we injected how much?
A mil.
Million?
A
Another
million.
million.
Yep, yep.
Because that takes us to a total of 3 million, correct?
Well, 3 million total,
Total.
in the in the CDARs that we're working through with them. So 2 million is already allotted,
Yeah, that's
is in the mix, and then you got the additional 1
Additional
mil.
1 million.
Right.
For a total of 3.
And
That's
there's
it.
988.
There's 988 left, 988,000 left. Yeah.
Okay.
So that's the real number. I'm sorry that's not more visible on that sheet. That's my mistake.
I'm like doing math, and I'm thinking, there's no way we're gonna install a concrete driveway and build a garage for $3,150.
Yeah, right.
I'm
Now,
like, okay.
I will say that we do have a loan in process. Another homeowner is in the application process with Portage Community Bank.
No.
So
Portage Community seems like they do a really, really good job.
they do.
Promoting it.
They
and
do. They
Getting
do.
folks, and then how about our hometown team?
Hometown, it's a good question. I'm going to be following up with them over the next few days and touching base. I have had really good relationships with our folks over at Portage Community Bank. I know Don Herman now, and we're in quarterly conversations. I haven't had the same relationships yet with the folks at Hometown.
Okay.
And that's on me. I need to do better with that. But yeah, I'm going to inquire with them
Yeah, I was just
and see how they're
curious.
just
Yeah.
checking in, how the heck they're promoting it, and what they're hearing.
Okay.
Yeah.
Yeah, I would be interested in the feedback from that because I know, like I said, I know some of the customers also at Portage Community, and a lot of these are in line with
Yep.
them. So that brings me to the point of we used to have 3 lenders, which was Middlefield, and then they had
Right.
a bunch of mergers and changes. So they started to step back from it, and
Yep.
then I don't think they were really doing a good job getting those
Promoting it.
promotion of
Yep.
it and utilizing it. And now, like I said, I'm just wondering, I'm not hearing Hometown, so what's
Yeah.
going on there?
I will, I'm making a note for myself that the next time we meet, I will have a report for,
update.
an
Yeah,
update for you on Hometown.
Or maybe they need some more brochures, or maybe they
Yeah.
just don't quite they've had a lot of changes, a lot of people are retired, so they got new people. Maybe it's something that we might have to revisit and do
Yeah.
a presentation to their LOs
Yeah,
to get them back on
it's a
board.
great idea.
John, did you have anything else on GrowLink update?
No, that is it.
Okay. Is there anything else for the good of the order?
Oh, ma'am.
If not, I'll entertain a motion to adjourn.
Second?
Okay, all in
First-
favor?
Aye.
Aye.
Aye. All right, we are officially adjourned. You hit your ding dong button for Sarah to cut us off.
I didn't hear that this morning.
I, real quick before Sarah comes there, I did have an email or a text from a viewer that said that they often listen into it, but they often wonder what we're looking at when we're going
Oh.
over these reports.
I see.
I remember Brad used to put some of the stuff
We,
up.
Yeah,
we
on
do,
that
we
screen.
do put the,
Posted.
your report up online, and I think she posted it this afternoon.
Yeah. What we did is while we were speaking of it,
No,
it would pop
what
up
we
on
were
the-
looking at.
Gotcha.
We would do a live stream.
I see.
Yeah,
That's what we
yeah.
would do.
So I think we need to go back to that.
Okay.
I mean, because it's open to the public. I mean, we have to